You're listening to the Washington State Real Estate Investing Podcast. This episode brought to you by the Easy Home Buyer, serving the Spokane and Coeur d'Alene area. If you're an investor in the greater Spokane area looking to connect with wholesalers, look no further than the Easy Home Buyer. Click on the link in the show notes to be put on their buyer list today, and check out episode 17 with the Easy Home Buyer founder, Chad Young. And by FlexiSpot, the maker of ergonomic furniture. If you're looking for a new adjustable desk, look no further than the E7 standing desk. The retractable frame allows you to adjust the desk's width from 43.4 inches out to 74.8 inches. So you can have a desk that is over 6 feet long that adjusts in height to fit the needs of your space and office. Save $20 now with the offer code WSE720 at checkout. Welcome back to Washington State Real Estate Investing Podcast. I'm your host, Jeff Udick. In today's episode, I chat with Shira Albert, a nurse and investor in large apartment complexes. She's located in Spokane, but invests in deals across the United States. Happy New Year's to you all. And with the new year, of course, comes new goals for our real estate adventures and investments. I think today's episode is perfect for the first one of the new year. Real estate investing is all about scaling and finding ways to make your money work for you and you not working for it. That brings me to today's investor's highlight, and that simple sentence that my wife and I constantly ask ourselves: am I working for money, or is my money working for me? It's a question I ask myself often when I'm doing finances, when I'm looking at our numbers on properties, and when my wife and I sit down and look over our finances. Unless you have been hiding under a rock, you know that inflation is climbing, and by the looks of things, even though it's slowing a bit, as of this podcast, it's not going to stop. In fact, I read an article the other day that the Fed is looking at upping the interest rates yet again. The problem, of course, is if you read all of the articles that are out there right now, you don't know what to believe. I read them, but at the end of the day, I come back to this one simple question. Am I working for money, or is my money working for me? That question is one I ask when we look over our finances. I look at the stocks we own, which, like most everyone else, have been hit hard this last year. It's been a rough year for that money in the stock market. So when I ask myself this question, am I working for money, or is my money working for me? Because my money is already invested, I then ask, how is my money working for me? It's easy for me to look at my investments in the stock market and get upset because they have lost 30% of their value in the last year. But because I play the long game with all my investments, I'm still up 70% on my cash I have invested in stocks. So how is that money working for me? I'll take 70% return on my investment, and I'll take the opportunity of this downturn to reposition some assets, take advantage of the dip, and prepare to have that money work even harder for me in the future. As a real estate investor, we ask ourselves the same question all the time. How is my money working for me? There are two data points that we keep track of: our cash-on-cash return in each property and our return on equity. Now, these might not be the same numbers you use, but for my wife and I, these are the two numbers that we use to gauge how hard our money is working for us. Let's talk about cash-on-cash return. This is my wife's favorite number. She always wants to know what the cash-on-cash return is on our properties. Cash-on-cash return is an easy and straightforward way to look at your investment. It's the cash flow divided by the actual cash you have in a property. So here are two real examples from our portfolio as I was just looking over this to wrap up 2022. The first property is a duplex. We took a loan out on the property and had to put 20% down. After putting 20% down and after any other capital expenses we had to put into that property, the cash that we actually have in that property is $34,398. That's the actual cash we have in the property. In 2022, we cash flowed after paying the loan, utilities, taxes, insurance, everything. Actual cash in our hand was $8,599. So our $34,399 made us $8,599. I divide 8,599 by 34,399 and I get 25%. So in 2022, our return was 25% on our investment. In 2022, the Dow Jones Stock Index was negative 8.78%. Here's the next property, a single family property that we bought and then put about $100,000 into it, turning it into a duplex. Of course, we want that money back out to go and buy the next property. So after turning it into a duplex and getting it leased up, we went out and took a loan out on the property. Because we added value to the property, turning it into a duplex and fixed it up, the loan we were able to take out covered almost all of our cost, all but $8,000 worth. So we have $8,000 cash left in this property. In 2022, it cash flowed $6,346. So $6,346 divided by 8,000 gives us a 79% return on our cash. The S&P 500 in 2022, negative 19.44%. It's pretty exciting when you ask yourself, how is my money working for me? And the answer is 25% and 79%. So that's how hard our cash is working for us. Both these properties outpaced inflation rates, so I feel pretty good about that. Now, are all our properties this good? No. We have one at 4%, and one where we rehabbed both units this past year is negative 97% return on our cash because of the rehab where it wasn't rented for roughly half the year and the money we put in it. Now, that's all fixed up, rented, we took out a loan on this property, so in 2023, our cash on cash return should be around 50%. Now, there is one other number that I look at when I ask myself, how hard is my money working for me? And that is return on equity, or ROE. Return on equity, in my book, is a number to keep in mind in everything you have equity in and have a loan out on. Our car, our own home, maybe you have student loans. I think it's good to track your return on equity so you know how hard that money is working for you. And oftentimes, it's what I call pent-up money. Equity is money you have in something, but you can't use it. It's just sitting there. Equity is the difference between how much you owe and what you could actually sell the asset for. Say you have a car. If you sold it, you could get, say, $20,000 for it. You have a loan on it that you pay on every month since you bought it, and the loan amount is down to, say, $5,000. The equity you have in your car is $15,000. When we're talking real estate, it's basically the same thing. We want to know if we sold this property tomorrow, how much money would I get? How much money is pent up, meaning I can't use it, I can't spend it, it's not really working for me, it's just sitting there doing nothing. Here's an example. That first duplex I shared, our cash on cash return was 25%. It has a different return on equity number. Here's what we do. We ask our realtor, Billy Dees from Dees Real Estate, to tell us if we wanted to list this property for sale tomorrow, what would it sell for? That gives us our market value. You could use Redfin or Zillow as well, but we trust our agent. Now, we don't bother him with this every month, but once a year or so, we ask him to update all of our properties for what they would sell for. Of course, as you know, that price fluctuates depending on the market. So your equity will fluctuate, which is why this is a good number to keep track of. So for the property in the first example, Billy gives us what it can sell for. I subtract the loan, which we would have to pay back. I subtract the cash we have in the property because I want that back out. And of course, closing costs, which I just estimate to be roughly 8%, because you really don't know what this number is until you sell, and I'd rather go high than low. So taking my sell number, I subtract these numbers, and I get $188,217. That's the actual equity we have in the property thanks to appreciation over the past 4 years. Now, my cash flow hasn't changed, so it's the same at $8,599. So I divide 8,599 by 188,217, and I get 4.5%. That $188,000 is pent up money. I have to make a decision. Do we leave it there and let it grow? Or do we sell this property, take that $188,000 and reinvest it in another property? Or are we okay with a 4.5% return on our equity? Now, in real estate investing, this is the exciting part and where you get to decide what's right for you. As a property continues to appreciate over time and you continue to make loan payments, the return on equity continues to go down. I could think to myself that this $188,000 is an emergency fund. I could sell this property and get $188,000 of cash, or roughly that, hopefully. Now, this is a property we bought in 2018, so it's had time to appreciate, which has pushed that number down. The last property we purchased had a return on equity of 17% because we'd only owned it for 2 years, and the appreciation had been much slower on this property. But as the property continues to appreciate and you continue to pay down your loan, you continue to make loan payments, the equity goes up. And the return on your equity goes down unless rent increases keep going up with appreciation, which hasn't happened for us. I'm always running numbers to see where we have pent up money and making sure we are using it in the best way for us. Do I like the way that money is working for me, or do I want it to work harder? Longtime listeners know I'm a fan of using home equity lines of credit, or HELOCs, because I find that for many homeowners, there is pent up money sitting right in your own home. Or you can sometimes, if you find the right bank, take out a HELOC on investment properties as well. But for the sake of today, let's talk about a primary resident. Let's say after the run-up over the last few years, your home is worth $300,000, and you've continued to make loan payments since you bought it 10 years ago, and now your loan sits at, say, roughly $100,000. You have $200,000 of equity sitting there in your home. You can then ask yourself, how hard is that money working for me? The answer is, unless you take out a HELOC, it's not working for you at all. It's just sitting there doing nothing. I mean, you're not losing 17% in the stock market, but what if that $200,000 could help buy you a rental property? We've used our HELOC for both purchasing new investment properties and, like we did in 2022, used it to rehab 6 properties, which allowed us to rent them for more and forced appreciation in them so they were worth more than they were prior to the rehab. Then we cash out refinance one property that paid back the HELOC, plus put money in our pocket. Our properties are now worth more and at the same time rent for more. So in some cases, our cash on cash return went down even though our monthly cash flow went up. We have more cash in the property and our return on equity went down because the properties are worth more after the rehabs. In the long run, we ended up with more monthly cash flow, which is great, but at the same time, we have more pent-up equity in our properties that we need to decide what to do with. Do we let it sit there and continue to grow? Do we sell a property and reinvest that equity in another property to continue growing our portfolio? These are the conversations we're having now because we understand our numbers. So to recap, ask yourself, am I working for money? Or is my money working for me? If I have money invested, how hard is that working for me? Know your cash on cash return, your yearly cash flow divided by the cash you have in the property. Know your return on equity, your yearly cash flow divided by the equity you have in the property. The reason why I share this investor highlight with you is because today's guest, Shira Albert, talks about all of this and how she helps investors invest in large apartment complexes. Be listening for terms like cash on cash return, return on your investment, return on equity in today's show. And if you are like me, when Shira is talking about some of the amazing numbers she's helping people get passive investing in real estate, you're going to want to think about how hard your money is working for you and your own personal financial goals. It's a great episode that highlights the power of real estate investing. Here's Shira from shirainvest.com. And with that, on with the show. All right, welcome back to another episode of the Washington State Real Estate Investing Podcast. I'm so excited to have Shira on the call with us today. We are going to be talking about large apartment complexes. This is the first time we've had a guest talking about residential real estate and large apartment complexes on the show. So I'm excited to dig in and learn more about this. Is it something I'm very interested in? My wife, not so much. We can talk about that why in a little bit. But welcome to the show. Give us a little bit about your background and how you got into real estate.
Absolutely. Well, thank you so much, Jeff, for having me today.
Yeah.
My journey is, it's not the typical journey. I think when you research real estate and you're really getting into it, you find a lot of people that got to start really early, had a lot of introduction into it, and mine did start with single family homes when I was pregnant with my first son. I was like, okay, this is exactly what I wanted to do. We also purchased a house with a rental in the back. So that was the first house, first time, and it was amazing. It kind of blew
Awesome.
my mind. It was like, wait, what? Somebody's paying you're developing equity, somebody's paying the mortgage, and it was fantastic. So we were in that house for a couple of years, and the market was very expensive, unable to really grow like I wanted to. So we ended up transitioning to Spokane, and that was also another time that I'm going to start growing my portfolio. It's going to be fantastic. And at this time, I was pregnant with my second son. I think he was about 3 months old when we had moved here, and we lived in an apartment for a little bit, locked down a single family home again, and one rental.
Oh,
Well,
wow.
then 2020,
Yeah, oh boy.
2020 hit, and it just slowed my growth so exponentially. It was frustrating because what you kind of learn when you're researching real estate and really getting started is like, oh, sure, you just stack it. You're going to start with your single family home. You're going to turn it into, next it's going to be a duplex. Next it's
That's
going to be a
right.
fourplex. You're like, yes, I got this. This plan seems easy. But when the economy slows down and then prices increase exponentially in an area where you're using your own money, your own funds, as a nurse practitioner as well. I don't even know if I said that. I'm a nurse practitioner by trade. I work a full-time job and
Yeah.
I now have 3 kids. So I was unable to scale my single family home portfolio. Around this time, I had an introduction to larger complexes. And I think when it first was pitched to me, I was like most people that I talk to today, absolutely not. You
Yeah.
have to do it the other way. You need
Mm.
to go the stack method. This is the only way to do it. And I realized being an older mom, busy, full-time professional, that doesn't have to be the case. That it actually may be something that most people should evaluate when they've already had more life happen to them and
Mm.
they're unable to necessarily make those commitments. You don't have to count yourself out of the real estate game just because you're unable to grow the portfolio on your own, in your own town, in your own backyard. And I think that's kind of a conversation that's not happening. That's my story. That's how I stumbled onto large multifamily, is somebody bringing this idea to my brain that you can scale either 1 to 30 units or you can go 100 and more and do the same amount of work,
Wow.
and
Yeah.
my mind was blown, and I was like, okay. Because when you start thinking of how long it's going to take to scale versus
Yeah.
where you want to be,
Yeah.
it really
Yeah.
starts to kind
When
of
you
weigh
start
on you.
Yeah, when you start thinking about how long is it going to take me to stack, right? This idea of doing a single, a duplex, a fourplex to get to 100 units versus, oh, I'm just going to go out and buy 100 units.
Exactly.
There
And
is just a different mindset behind it, and just a different level of growth that you can get as well, right?
exactly. And it's kind of like you have to let yourself grow in that way. I think you definitely want to hold yourself back and say, I can't do it. There's just no way. There's
Sure.
just nothing I can do because I can't. 100 units, I can't do that. I didn't do
Yeah.
30, but you have to let yourself grow. You have to let yourself be open to the opportunities that are approaching, you and are coming to your plate, and accept it and realize that it just may be the path that's meant for you, and don't fight it.
Mm.
So with that, I stepped into large multifamily and I love it. I'm Not sure if I'd ever go back to single family home. Maybe if there was something special, but um, I think the market's transitioned a lot for investors planning to use the single family home route to grow
Yeah.
their portfolio.
Yeah.
I don't know if you've seen that as well too.
I have, and we can talk about some of the things that we're dealing with right now. But I talk about for just a moment, what was it for you that, and what is it still now that you see this? And one of the things I want to point out is you are based in Spokane, but
Hmm.
you actually invest, and this is something people need to know. You're investing in large apartment complexes all over the nation.
Absolutely.
I think a lot of times another one of the mindset is, well, I live in the Tri-Cities. I can only invest in the Tri-Cities because if the toilet backs up, the thing everybody always uses, I have to
Hmm.
go fix it. Right.
Absolutely.
And to be
Hmm.
thinking that, the real estate game today, and especially with the technology that we have, you don't have to. You can live in Spokane, be a nurse practitioner, a full-time mom of 3 kids, and still do this. Can you maybe talk
Absolutely.
about why maybe for someone who is, a full-time job, has kids, has a growing family, why might large apartment complexes, and what do you find about them, and why do you think this could be a path for others?
Um, I think it's exactly like you said, is real estate, when you first start it, because you're starting smaller, you do take on so much of the responsibility of the plumber, the landlord, the maintenance person. You take on all those things. And you also try to keep it right in your backyard as well. So then you're
Yeah.
driving by the property. Anything that happens, you're responding to it. But when you are a person that is starting with all these other complicated aspects to your life, it's really not feasible. It tends to hold you back because you're not able to grow in the way that you need to grow because the timing isn't there.
Right.
Maybe even the resources or the experience isn't there. So it's really kind of holding you back. So I think we need to really start. That's why what kind of really sold it on me is I think a lot of people need to be okay saying, I don't want to be a property manager. You
Mm.
need to be okay with that. You need to have that honesty and that conversation with yourself to say, I love real estate, but I don't want to find out about toilets. I don't want to.
Yeah.
I remember your podcast about your wife liking design. I don't really love design.
Right.
That's not strong for me, and I'm okay with that. There's nothing wrong with it. I just have to look at real estate a different way.
Mm.
And large multifamily allows you to do that because not only are you investing, not having to stick just in your own backyard and basically miss all the growth that's happening, you're able to branch out, partner, and grow exponentially because you're not limiting yourself by your own skills, your own resources, and your own opportunities. So that's what I love about it.
I love that. Let's talk a little bit about the partnering potential, because I think this is another part when it comes to large apartment complexes. People are going to be listening to this being like, well, guys, that sounds great, but I've only got $40,000 or I've only got $60,000. I can't go buy a $12.5 million 80 unit complex. Can you kind of
Right.
talk? I mean, and feel free. I mean, I know that you run a website and you are running deals right now. So kind of talk about this idea of how you can partner in real estate this way and get to that idea of exponential growth.
Absolutely. So that's also another aspect. Thank you for bringing that up. Is I love the partnership of it.
Mm.
That's also, it forces people to not rely on themselves because you can't do it, because you literally don't have all this money, time, and skill to just do it by yourself. So it really forces you to network, to reach out, to meet people where they are and find out how you can make this creative partnership happen, what people are looking for, what you're looking for, what other opportunities. So the best part about it is, as far as our company and our investors, is yes, we have minimums of investments, but it allows people to stay active for 50,000 to have a piece of it, and get equity and get payout and get cash flow and get appreciation and depreciation. It allows them to do it with this small amount of money, but you don't have the headache. Nobody's calling you to figure out what to do with tenants if there's evictions, if there's plumbing issues, if there's all these other things that you normally would have to manage. So the partnerships are just the core aspect, I think, of large large complexes, period. It's never going to be just you. And if it is ever somebody that is pushing just them, I'd be extremely leery about it, because it's a lot of money, it's a lot of time. There's a lot of due diligence that has to happen when you are acquiring an asset. So it definitely should be something that's a partnership, that you're getting tons of information on, that your questions are being answered, but you're also being led down the pathway of success by somebody that is experienced, which is,
I love
the
that.
big
Yeah.
thing.
And I think that's a great way to put it. Like anytime you're starting into a new, this idea called syndication, right? Where you're putting together large multifamily deals like this, to be a partner, that whatever that is that you bring to your first time,
Hmm.
it could be money. I just bring the money, and you
Right.
handle the paperwork and the building of the complex or managing it or whatever. But then you start to gain experience, and you can bring other things to the table as well, which then can give you more equity into that deal. Can you maybe
Absolutely.
just walk me through? I have, and I'm just going to throw a number. I've got $50,000.
Hmm.
I find you, and I'm like, Shira, I got $50,000. I'm looking for an apartment complex. What's my next step? What am I
Perfect.
going to do with you?
So with me specifically, the larger complexes get a little bit complicated as far as SEC regulations. So
Mm,
when somebody has money that they'd like to invest and they're not an accredited investor, that means that we have to have, or the deal is a specific deal that doesn't just allow you to publicly kind of put it out there, which are a lot of the deals that I do, because I'm trying to bring more opportunity to people who normally don't have it. So per guidelines, we need to have a relationship. So you need to schedule a phone call with me. We need to talk about your goals. We need to make sure that Shire Investments is the right fit for you, and that you're the right investor for us as well. We really need to get those things out, which I think is an important step, because yeah, having $50,000 and just finding somebody's like, oh, I'll take it. That's not really what you want to do. You want to know, what are the expectations? What are your requirements? Is this going to be a good fit? Is this a city that you're looking, and you
mm,
believe in? Is this a property? Is this a team that you believe in? So that's generally how it's going to start. Now, once that, if we go to the same page and we're like, yes, this is great, this is fantastic. At that point, then we can get you into our investor webinars to really talk about previous properties and really kind of give you more information about it. We can also put you in our investor network and start giving you the opportunities to invest in these deals. And the great thing about partnering with the billion-dollar management company that I do is these deals come up often. And it surprised me how often they came up, because I feel like I'd never heard of them. It just didn't happen. So I was like, wait, there's a deal here. There's another deal here. Wow,
mm,
there's this. There's so much opportunity out there. And I think a lot of people aren't having these conversations. They don't know it exists. So it's really about, getting to know people, reaching out. If you have the funds to start connecting with people and getting yourself on a list to start getting these deals sent to you, and having that, preferred notification. That's really how it works. It's kind of
yeah.
beautiful.
I it's so cool. I get so excited when I'm talking with you. I'm just
I
like, I
know.
need to do this. I got to get my wife on board, because as you heard in the episodes, she loves the design
I
piece.
love it.
And her problem is she can't get out of her head. Okay, we're going to buy these complexes, and I just have to design the same thing over and over and over
Yeah.
again. I mean, we have a
Yes.
fourplex, and she doesn't like the fourplex because every unit looked exactly
Looks
the
the
same.
same.
It's just like, this is
Oh,
boring. So it doesn't fill her
she's
bucket. So we're
she
still,
should be short-term rental, because I kind of feel like short-term rental, if there was ever anything that deterred me, it is the design portion. It
yeah.
literally is like, especially now with all the changes, you need to have that high level design. So,
Well, and we just had our first Airbnb in Spokane, and it is going like hotcakes. But part of it's because she loves staging it, right? I mean, it is
hmm,
staged perfectly, and everybody that stays there is like, this is the cutest little apartment, and it's got everything in the kitchen because she's a big cook, and so she made sure there's everything there because we
oh
stay
my
there every
gosh,
once
I
in a while
love
when we're working on properties. Anyway, but you're right. That's her place. That's where she
that's
lands.
her
So.
strength, and that's
That's her
okay.
strength. And so it's hard for me to be like, let's go do this. Let's
Yeah.
go get a couple hundred. And she's like, nah, that doesn't appeal to her yet. I'm working on it. I'm working
You're
on it.
working on her. Hmm.
And now I've got you, Shira. So we'll be good. I'll keep
We're
working
gonna
on
we're
it.
gonna tag team her. We're gonna
Right,
get her
that's
on
right. We'll
board.
tag team her. Yeah. Let's talk a little bit about this asset class in Eastern Washington. I know that
Mhm.
you've got large multiplex apartment complexes all over the nation. But let's focus in a little bit on Washington State. What are you seeing in Washington State, specifically maybe Spokane or Eastern Washington, or maybe
Mhm.
some places you're looking at here in the state?
Um, so Eastern Washington is kind of a unique area. Spokane specifically, even though cap rates I think are extremely compressed right now, meaning like things are just really expensive compared
Yeah.
to other areas where you're going to get something equal but for a lot less, which is going to the compressed cap rates kind of lowers the cash flow. So it is a little bit harder to find things that are attractive to
Mm,
investors, because
right.
everybody's really looking at, we offer our investors the the real goal when we're sourcing to double their profits within 5 to 6 years, mainly
Okay.
6 years now with interest rates and things like that, and to in between refinance and sale to have about 8 to 11% cash flow, preferred cash flow returns. So trying to really maintain those numbers, it is a little bit tougher here, but I still think there's gems here. You just really can't count out areas. For one, Spokane's not a transition city. And I say this to a lot of people, especially people who haven't bought houses yet and are like, I'm waiting till they're $50,000 again or
Yeah.
125. And I was like, Spokane's not a transitional city. Nobody comes to Spokane and says, oh, I'm going to be here for 2 years and I'm going to turn around and I'm going to sell my house. It
Mm,
doesn't happen. People stay here. My neighbors in my neighborhood, 70, 80. They are
wow.
literally going from, their homes to nursing. People stay here. They have their
Yeah.
kids here. Their kids go to college. And that's why I'm here, because I'm going to stay here.
Yeah.
So I think you really have to bet on Spokane. You really do. That the growth is going to continue to be here. The population is going to continue to grow. We're going to need more and more housing here. So I think really getting in early and really staying focused is going to be a big part of what I'm aiming at now, is to really invest in the city that I live in.
Mm,
Is really get, money here and build the community. And I think Eastern Washington is growing. I think it just isn't going to be as easy as some other states like Tennessee or Texas or other things, because there's financial challenges because it has grown so quickly. The
yeah.
prices have advanced very quickly, but it will even out. But I
Yeah.
definitely think it's a place to still keep your eye on. You
Yeah, and
know.
I think there's I couldn't agree more, and I love the way that you put that Spokane isn't a transitional city, and I couldn't agree more. I think we see that, and I think the underlying, when we talk about Spokane specifically, the underlying industries are continuing to grow, and industries are continuing to come in, and therefore so is population. But it's really interesting across the state, and one of the reasons why I love this state. I did live here for 10 years when we lived overseas, and this is where we came back to for a lot of different reasons. I grew up in Spokane. I live on the west side. I with my other job in consulting, I've visited every corner of the state, and it's just so diverse, and I love that about it. But even I think yesterday or 2 days ago, I was reading an article that Pasco, Washington, is number 8 on the fastest growing small to medium size cities, with like
Interesting.
18% population growth over the last 2 years. And a lot of people might read that and be like, really?
Hmm.
Pasco, the Tri Cities? But if you haven't been down to the Tri Cities and see what is happening down there, especially around science and engineering, people don't think of the Tri Cities of being a science center. But with
Hmm.
Hanford there is a lot of science and technology that is coming into the Tri Cities. And then on the outskirts of that, for those of you that live in the state of Washington, there's this little thing called the wine industry that continues to blow
Hmm.
up, and the Tri Cities is the middle of it. So it doesn't surprise me that places like even Pasco, I think we're going in my world, I think we're going to see places like Yakima
Yes,
as
absolutely.
we start getting into this second home where people can work from anywhere. A place like Wenatchee where you can be in the ski slopes or out hiking. There's just, I think, even in the middle part of this state, some of these smaller, medium-sized towns really have a lot of potential if you can, see it
Right.
forward thinking,
If you
see
can
some of
stick
the
with
investment
it,
opportunities there. Yeah.
definitely stick with it, because yeah, there is so much growth.
Yeah.
It's crazy to watch it. I know it's must be even a more unique view to have been here as a child. My best friend is born and raised in Spokane, And same thing for her. She just can't believe it. She cannot
Yeah.
believe the city that it's turned into. And I'm like, you should be proud.
Absolutely.
Spokane's grown in an amazing way, and it's
Yeah.
continuing to grow. And
Yeah.
I'm still trying to get all my family to move here. I'm like, it's so fantastic.
You
It's
gotta come up here. I love it.
amazing. Come on,
Yeah.
guys.
Yeah. It's
So
great. It's
it's
great.
great.
Um, let's real quick. Let's talk about, do you have, what are 3 questions if there's an investor or someone listening to this podcast that says, you know what, this might be something I want to skip the duplex and the fourplex. I want to do something bigger. I got Shira here.
Yes.
What are 3 questions they need to be asking themselves when they decide, is large apartment complexes right for me? What are kind of, as an investor comes to you, what are some of those questions that you ask them or they should be asking themselves?
Um, Great question. So I think my first one would be the operator's experience. That's
Mm,
always kind of it, because as we talked about earlier, it's a partnership, but it's a partnership that's leveraging different things where you're bringing in money. You need to be leveraging somebody's experience
mm,
and successes and cycles in this ups and down in the market, and knowing how to maneuver in complicated situations. So for our investors, we partner with only people that have multi-million dollar portfolios and multiple cycles under their belt, because we don't want to go out there and say, this is my first one, I don't really know what I'm doing, sorry about your
yeah,
money. Because this is, the opportunities that we're bringing to people, they still need to be successful. That's what we're aiming for. Is we're not trying to go out there blindly putting people's money at risk, because they worked hard for that money,
yeah.
and they're relying on you to bring them across the finish line. And so the experience, I think, is a very big thing. Um, Second question: what kind of returns? What are
Mm,
you really looking for? What is your time limit that you're really looking for? So, I think I did say we try to do with our investors to source deals that are doubling their money, which is
wow.
kind of unheard of.
Yeah.
Which is also forgot to say is another thing that really stuck with me, is 5 to 6 years of doubling your income or your investment.
Investment.
That's not
Yeah.
happening. 50,000 in, 100,000 out. You know, like
In
that's
5 years.
in 5 years. In 5 years,
Or
when
6. Yeah. Yeah.
5 or 6, or even if it's 7, you know what
Yeah.
I mean?
Right.
100%. Where else are you getting this kind of return? As
Yeah.
well as some, 8 to 11% cash flow. So, what kind of returns? And then I also like to make sure that people are aware of the timeline. It
Yeah.
is 6 to 7 years. It's
Yeah.
different than, I think, what we retroactively think of real estate, because things are like quick, a flip, 6 months
Right.
max, so the timeline is a little bit different. But I think that's why it's perfect for working professionals, nurses, doctors, people that already have full-time jobs, the other full-time job of family. And now, these are things that you just want to pan out in 5 or 6 years. You just want these things
Yeah.
to work out, because you don't have time to kind of be managing and moving your money around and all that good stuff.
Yeah.
And the third question would be, where I think it's a good question to kind of reflect for a lot of people, is where are the various funds coming from? So
Mm,
I think there's a lot of people who don't realize how much access to capital they have from either a rental standpoint, not necessarily HELOC, because it is
sure.
a longer period. But if you're able to manage it in your rental, I think that's another option. If it's covered by the rental income, IRAs, retirement accounts, self-directed. I made the mistake of rolling money over into another 401k before realizing that I could put it in a self-directed account, and I just want to scream it from every roof everywhere. You can have so much control over your retirement account when you have, an old 401k from another employer. That's money that you don't even have access to, that so many people have, that they don't even think to invest with it.
Yeah.
I have multiple coworkers who's just sitting there. It's just sitting, not growing.
Yeah.
They're dealing with the stock market
Yep.
decrease now. And I'm like, take control of it, guys. You
Yeah.
have so much money, and it's money that you don't even have to take from your day to day life. That's money you've already saved.
That's right. Yeah.
So I think those are really big questions to realize that, it's a great way to invest in real estate using these funds, and where to get these funds. And you could you need better returns than the stock market, but you also can't leave it to dwindle away in a savings account. So,
Yeah, it's so
you know,
true. So true. You are very passionate about helping those in the medical profession, specifically being an
hmm
RN yourself and a mother of three. Can you
yes.
talk a little bit about that passion? And as you kind of just alluded to, you're like, you've got money sitting in this IRA.
Exactly.
What do you do with your money?
Yeah.
Can you kind of just talk about where's that passion come from and how do you like to support those in the medical profession?
The passion comes because I live that life every day.
Yeah.
I live that life every day, and I realize that so much is not talked about. Being a nurse for 16 years now, my husband and I were actually laughing about it last night, which is sad that we're laughing, but it is funny that if we both wouldn't have had one person in the nurses station who happened to be working with their 401k set up our 401k
Yeah.
contributions, we would have never had a 401k.
Yeah.
And I was like, that is so crazy that that was the only
Mm,
opportunity that somebody had, that I had in my life, that somebody was like, hey, start thinking about the future. This is what you need to be doing. These are ways you can do it. They take it from your check. And I was like, okay, sounds good. Sure. I don't know what I'm doing. And I think that, as far as medicine, it's just not talked about. And I know after the pandemic, so many people are leaving medicine, but they don't really
mm,
have a plan. They don't
mm,
really have a way to get to the point that they wanted to either retire, maybe take some time off, maybe have better vacations, maybe buy the house, the vacation or whatever they're really geared towards. So there's no conversations about it. So I just feel so passionate because, like I said, I have so many people who are transitioning from jobs. And I know that you've probably seen a ton of people transitioning that have retirements that aren't growing. They're not doing
yeah.
anything with it. There's just a lot of money that can be invested in real estate without much strain or stress.
Mm,
So I really just want people to be aware of it and to be taking advantage of it because, you're not, it's for you. Make it grow,
yeah.
make it work like you did.
Yeah, and I think you bring up a really good point. I mean, where we are right now, with the outlook on the stock market, what is your money doing sitting
Mm-hmm.
there? Is it growing at all? Is it decreasing in value? And
Decrease.
which is even worse,
hmm
you're sitting there watching your savings being like, "Well, wait a minute, I already made that money. How can I be losing it?"
Exactly. That's
And
exactly it.
is there some other way that you can use that money? And I like, I think being able to reflect on where you have money sitting. I talked about
hmm
this in a podcast, not that long ago, where increase, especially here in the state of Washington, a lot of homes increased in value big time over the last 4 years. And even though we're going to see a little bit of a drop back, even if it drops back 10%, we
hmm
saw like 50% growth, 10% on that. You still
exactly.
got a lot of equity built in your house. There's a HELOC sitting there,
hmm
right? And what can you do with that HELOC that you can, and how do you play that? And, I mean, there's a lot of different ways that you can look at money that you have and make
hmm
sure that it's in the right spot, doing the right thing for you in your situation.
Right.
And that's
And
that's the thing I love about real estate.
I think like you bring up a really good point that I also want to touch on is we're also having like a weird time of difficulty of people getting into their first home.
Yeah,
And so um, they've been saving, they have these down payments, they have all this money sitting there in savings accounts
yeah,
and nothing to do with it because they're
it's
not
true.
qualified, they're priced out of the market. And that's kind of another big conversation is we need to start pushing millennials and people who haven't quite been able to purchase a house to still grow their money. It doesn't matter if
Yeah,
you have to wait another couple of years.
that's
You
a
don't
good
want to
point.
just be sitting there,
Yeah,
waiting and waiting and waiting. You want to, I mean, it's best to tie it up for 4 or 5 years, maybe 6 years, and
double it.
double it, and then revisit the fact, because
Yeah,
I think once you start making that money, it's going to be a different conversation about what kind of house you really even want. What's going to
mm,
be your first house? Is it even going to be worth it for you to do it right now, or maybe it's something that as your money has grown and cycled 2 to 3 times, you're building your own house.
yeah.
A way different conversation of the starter home and what that means for people.
I love that. I love that. Talk a little bit about where you are now in your real estate journey. How many units do you have under contract? What are your future goals? What's that look like for you?
So currently, I've been blessed to be a general partner in a little under 200 units, two different
Wow.
complexes. I'd love to grow. My goal specifically for me is to partner in at least 2 to 3 more deals this year,
Okay.
2023. I just want to. It's a lot of work, so it doesn't sound like a lot, but it's such a labor of love when you're doing it.
Yeah.
that I just want to do it as much as I can, as much as my children will let me do it and my husband, as much as they will.
Yeah.
So that's my goal. And then participating and supporting as many other operators that I know need help raising capital to get people in there. Because even if I'm not bringing you the deal specifically, I have a lot of connection and opportunity for other people. And I want to make sure that people have as much opportunity as possible, and not just trying to keep it all for myself. I really want to I want to watch people grow. I want to grow together.
I love that. I want to grow together. That's such a great
Yes.
way. Well, Shira, thank you so much for taking time to chat with us today. If people want to learn more about you, your company, deals you have at the moment, deals you want to have on the table, where should they go? How should they reach out?
Definitely. Please reach out. So it's Shira Investments. It's SHIRA, my first name, investments.com. Pretty simple. You can also find me on, Instagram, Shira Albert, Shira Investments, and just reach out. I'm willing to have conversations with anybody. If you have questions, please. I mean, it's best for your interest to be perked a little bit and ask a question, so that you
I
can
love
really
that.
start having these conversations, because I think sometimes you just get isolated and not have the conversations of growth that you need to. So please reach out, send me an email, shoot me a message. We can definitely chat about it.
Awesome. And if you have a friend who's in the medical profession and they've got this IRA sitting over there, send them to Shira. She'll
Right. I
talk some
actually
sense
have
into
a
them.
free ebook. I forgot to say, I have a free ebook that kind of talks about it too. So
Oh,
you can go to
great.
my website, you can get an ebook and kind of get an overview of what apartment investing looks like. What are the returns? How does it work? What are your expectations? Just so you kind of have an idea about it as well.
Awesome. And we'll make sure all of those links and everything for Shira are in the show notes, make it very easy for you all to click on down there. Shira, thank you so much for taking time to chat with us today. Congratulations on all your success.
Thank you.
And
You as well.
Hopefully we get some more people to reach out to you and help others be successful as well. So I really appreciate you taking time to chat with us today.
Thank you so much for having me. I really appreciate it. This was so much fun, and congratulations on your podcast. It's a smash. It really is.
Thanks.